let's get into this. We've talked about the new normal a little bit with the things rolled last year. We've been tracking price movements in the construction market since the early 1960s. Our industry historically used survey methods. We did it amongst our peers in the estimating profession as consulting quantity surveyors in Canada, and in conjunction with input price data for inputs such as labor and materials, we come up with recommendations for our industry. But as markets became more volatile through the 1980s and again in the early 2000s with the dot-com bubble, we found that this methodology was too little and too late. And through the 1990s, we created an elemental trade hybrid line item method for tracking construction costs. And with this information base, we were able to directly measure price trends through these booms and busts, as you can see with these dots and lines and snakings and so on. And if we combine this empirical price data with a better understanding of underlying financial conditions, we could at least share that relevant data with the industry and perhaps point to likely future movements and trends. So this led to our market outlook in 2006. The key driver for price levels in the economy is the money supply, with the Federal Reserve controlling this supply for the most part through interest rates depicted here by the orange line for the federal funds rate and quantitative measures indicated by the green line for reserve assets. Through 2006 and 2007, with price levels for commodity stocks and real estate all accelerating, the construction industry generally forecast a ramping up of construction price escalation for 2008 and beyond. But our view at the time, based on previous credit cycles, was that prices would peak, then level off or decline, depending on how well financial authorities could contain the obvious bubbles that existed in housing and commodities. So now, after a 10-year expansion, we can see an unprecedented response to the pandemic. Major input metrics of the Fed, prices depicted by the black line for the New York Stock Exchange Index, and employment depicted by the unemployment rate reacted instantaneously to the lockdown and social distancing orders across the globe. So the response to the financial crisis and the current response to the pandemic are unprecedented. And let's look at some history to gain some perspective on where we are and where we should be going. All right, so economic booms and busts have been around for as long as money and credit, reaching back to early trading economies and further to the invention of money, such as precious metals. We can see from the chart that a pattern of rapid booms and busts pre-World War II has been succeeded by a long period of consistent growth with periodic recessions. As the Industrial Revolution took hold in the US, the expansion of both the old agrarian economy and the new industrial economy put an enormous pressure on a financial system based on a mostly fixed monetary base, the amount of gold. Successive credit booms were followed by busts as price levels deflated over time. When credit was scarce, farmers suffered as they depended on borrowing to plant their crops. They suffered further when they went to market as deflating prices hit their sales. Farmers were well educated on their reality, and a political movement was born to replace gold with a quickly expanding supply of silver. And meanwhile, industrial enterprises tend to self-finance through retained earnings and rapidly increasing productivity. So in order to backstop the system, the Federal Reserve was created in 1913, tied to the gold standard and a long-standing established orthodoxy. The Federal Reserve was no match for world events such as the First World War, reparations, German hyperinflation, stock market crash of 28, and the subsequent Great Depression. So there was never a harder lesson learned than the Second World War. Coming out of it were new ways of thinking about trade, financial sector regulation, war reconstruction plans, government spending, and the monetary base. Over time, particularly with the war in Vietnam, space race, new society, social spending, the guardrails attached to the post-war system started to crumble, and the age-old hazard of fiat money started to ratcheting up of inflation and inflation expectation. So the world turned to the Federal Reserve for answers, and new prestige came to the institution as inflation-fighting austerity and relatively freewheeling asset booms characterized an expansion in production that moderated inflation. However, the success papered over an underlying weaknesses that time and deregulation had created. Financial crisis laid bare these weaknesses, but with one of the great successes of our generation, being a boomer, I'm looking for something to be proud of. The crisis yielded not only a highly sophisticated set of stress tests and regulatory authority, but a culture of transparency and interagency collaboration that characterizes our financial discourse today. This new normal goes beyond rules and definitions to create an ever-evolving environment of checks and balances. We can see it here in the willingness of the Fed to both redefine their mission and methodology for both employment and inflation, but in a real-time course of evidence-based dialogue. But let's see what this means for employment. The Fed will continue to provide stimulus because the new normal says that the Fed will act until there is evidence, as opposed to expectation, that employment levels are strong. Previously, if the unemployment rate reduced, the Fed would tighten to ward off potential rise in inflation. Again, you see the Fed pointing to not only resuming previous employment totals, but increasing the overall size of the employed workers in the economy. So while prices will likely tick up, inflation will need to exceed the 2% long-term average for some time in order to move the long-term average up. Therefore, our projections coming out of this pause in price levels, or bid price levels at least, is for significant escalation to recoup margins and bring supply growth back to normal and beyond. Significantly, the Fed will not react to what they consider one-time increases in prices. As with the rapid drop in oil prices in the first stages of the pandemic, these price movements adjust for market conditions and smooth out over time. This chart shows the new normal very clearly from 2004 to 2006. The old regime of rising interest rates in the face of asset bubbles led to the financial crisis. In 2007 and 2008, the unprecedented reduction in interest rates and increased quantitative measures due to the unfolding credit crisis and the stock market crash. From 2011 to 2015, continued quantitative easing caused an unprecedented stepped rise in investment asset prices. Economic and growth recessions occurred along with an expansion in the labor force. From 2016 to 2019, interest rates were raised in expectation that inflation would rise. That's what I mentioned a moment ago about expectation versus evidence. This is the mistake the Fed made that led to the new normal. Inflation did not rise. Asset prices started to crash, as you can see, and the Fed changed direction with a significant drop in interest rates. Then with the pandemic, a whole new immediacy to both rate reductions and ongoing quantitative measures. Fiscal and monetary measures worked in tandem to support price levels in the face of a shock to both employment levels and the fundamental structure of the economy. So as we can see with the commodities report from Lindbeck, these price level increases might stick at a higher level. Those margins might need to stay in place for a while for that market to increase their supply chain. But that's not inflation. That is a one-time rise that potentially will drop back down, and it induces a sharply increased supply to come along. And that's not what the Fed is looking at for inflation. They're looking for underlying inflation across a broad base. So that's what they'll be monitoring over 2-3 years to really have an evidence basis for a real change in monetary policy. This, along with these structural changes in the economy, such as getting back to work in people's offices, trends for infrastructure spending as some of these spending bills and fiscal measures continue to unfold. We'll be watching those through 2021 and beyond, so stay tuned.